On February 2nd, 2026, something violent happened in the silver market. Silver didn't drift lower, it collapsed. In a matter of hours, prices plunged from near $88 to lows around $71, erasing weeks of gains in a single session. If you were holding silver, physically or on paper, you felt the shock immediately. And if you weren't watching closely, you probably missed what really mattered. Because what happened next is not being explained honestly. While headlines focused on profit-taking and technical pullbacks, something far more important was happening quietly behind the scenes. And once you see it, this crash stops looking random and starts looking engineered. Let's slow this down. Silver opened strong, pushed higher early, and then suddenly reversed with extreme force. Stops were hit. Leverage was crushed. Traders were forced out at the worst possible moment. This wasn't a normal correction. This was a flush. And here's the critical detail most people missed. Right as volatility exploded, margin requirements on silver contracts were raised sharply. That meant anyone using leverage suddenly needed far more cash just to stay in the trade. For smaller traders, that's not an inconvenience. That's a death sentence. They had two choices: add capital immediately or sell. Most sold. And when forced selling hits a thin market, prices don't fall gently, they fall violently. Now, you might be thinking, this is just how markets work. Volatility rises, margins rise, weak hands get shaken out. End of story. But here's where it gets uncomfortable. Margin hikes don't hurt everyone equally. They punish speculators and retail traders first. Large institutions don't scramble. They wait. They already know the rules, the timing, and the pressure points. And during this exact window, while panic selling was ripping through the market, reports began to surface that one of the largest players in silver had quietly reduced risk. J.P. Morgan. According to market chatter and positioning data, J.P. Morgan appears to have closed a significant portion of its silver short exposure near the $78 level, right in the heart of the chaos. If that's accurate, it means one of the most powerful institutions exited calmly, while everyone else was being forced out. That alone should make you stop and think, because when the strongest player steps aside during a crash, it usually means the most dangerous part of the move is already over for them. This isn't about conspiracy theories, it's about structure. When leverage builds, markets become fragile. When pressure is applied through margin hikes or liquidity stress, the weakest positions are liquidated first. And once that selling is exhausted, control quietly shifts. And here's the part that should really concern you. If this was just a routine sell-off, we wouldn't be seeing physical silver premiums rising. We wouldn't be seeing delivery delays. We wouldn't be seeing paper positions collapsing while real-world demand stays firm. Those signals don't appear in healthy markets. They appear when something underneath is breaking. So ask yourself this: if silver is truly unwanted, why is physical metal getting harder to secure? If the bull market is over, why are long-term holders refusing to sell? And if this was just a coincidence, why did the pressure hit exactly when it did? This move wasn't the end of the story, it was the opening act. Because once you understand who benefited from this crash and who didn't, you start to see why your savings, your purchasing power, and your financial future are now far more exposed than you realize. And that's exactly what we're going to break down next. You might be thinking, this was just another volatile day in the silver market, a sharp move, some panic. Then life goes on. But that assumption is exactly what puts your wealth at risk. Because this crash wasn't just about silver prices. It was about what happens to people like you when markets reset violently. If you hold savings, if you're planning for retirement, if you're trying to protect purchasing power in an inflationary world, this move matters more than most people realize. Here's why. Silver isn't just a speculative trade. It's one of the last remaining monetary metals that still reflects stress inside the financial system. When silver moves this aggressively, it's rarely isolated. It's usually a warning. Over the past year, silver had already risen more than 150%. Even after this crash, it remains significantly higher than where it was 12 months ago. That kind of performance doesn't come from hype alone. It comes from deep structural pressure. Pressure created by debt, by currency debasement, and by a system that requires constant liquidity just to stay upright. Now think about who gets hurt when volatility explodes. It's not the institutions with unlimited credit lines. It's not the banks with access to central bank liquidity. It's households, it's pension funds, it's anyone relying on stable markets to protect long-term savings. History is very clear on this. In the mid-1970s, silver suffered a brutal correction, nearly a 50% drop, before going on to one of the most powerful rallies in its history. The people who sold in fear locked in losses. The people who understood the setup didn't. And the setup today looks uncomfortably familiar. We're once again seeing a widening gap between paper markets and physical reality. Futures prices swing wildly, while physical silver remains tight, premiums stay elevated, delivery times stretch. Real demand doesn't disappear just because prices fall on a screen. That disconnect is where risk lives, and it's also where opportunity forms. But here's the part most people don't like to talk about. This system isn't neutral. There's a constant tug of war between retail participants and large institutions, between leveraged speculation and balance sheet power, between paper contracts and real metal. And every time volatility spikes, that imbalance becomes painfully obvious. Ask yourself this: who is more likely to be forced to sell during a margin hike? Someone with a trading account or someone with access to billions in liquidity? Who feels panic first? Someone watching their retirement shrink or a bank managing risk exposure? This is why these events always feel one-sided. And this is where the uncomfortable question arises. Were these pressure points accidental or were they predictable? Because when the same pattern repeats across decades, leverage builds, margins rise, weak hands exit, strong hands survive, it stops looking random. It starts looking planned. Not necessarily coordinated in secret rooms, but structured into the system itself. And once you see that structure, you understand why these moments matter so much more than daily price moves. This isn't just about silver. It's about how wealth quietly transfers during periods of stress. It's about who gets trapped at the wrong time. And it's about who walks away positioned for what comes next. Because someone always benefits when markets break like this. And in the next chapter, we're going to name exactly who that is and why their motivation matters far more than the price action you just witnessed. To understand what really happened, we need to talk about one name that keeps appearing whenever silver is under pressure: JP Morgan. Not because of rumors, not because of internet theories, but because of history. For years, JP Morgan has been one of the most dominant participants in the silver market. Through futures, options, and complex derivatives, the bank has maintained enormous exposure, often on the short side, giving it outsized influence during periods of stress. And here's the key point most people miss. Large banks don't trade silver the way you or I do. They don't react emotionally to price. They manage risk across cycles. They reduce exposure when volatility peaks, not when it's calm. That's why reports suggesting JP Morgan closed a meaningful portion of its silver shorts near the $78 level matter so much. If true, it means the bank reduced risk right when forced selling was at its worst. Think about that. While retail traders were being liquidated by margin pressure, one of the most powerful institutions in the market was potentially stepping aside, calmly, deliberately, and on its own terms. This isn't about blaming a single bank, it's about understanding incentives. JP Morgan doesn't need silver prices to go to zero. It needs disorder to settle, volatility to peak, and weak positions to be flushed. That's when control shifts. And once you recognize that pattern, the recent crash stops looking like bad luck. It starts looking like a phase. Because the question now isn't what JP Morgan did, it's what happens after they're done. This is not the first time silver has behaved like this. In fact, history shows that silver almost always moves this way before its most explosive rallies. Go back to the mid-1970s. After a powerful run, silver collapsed nearly 50%. Headlines declared the bull market dead, traders capitulated, confidence evaporated, and then quietly the market turned and went on to deliver one of the strongest rallies in modern history. The same pattern appeared again in 2008. Silver was crushed during the liquidity panic, falling alongside everything else. Paper markets imploded, but physical demand never disappeared. Once forced selling ended, silver didn't just recover, it multiplied. These moments all share the same structure. Leverage builds during rising prices, volatility increases, exchanges tighten conditions, weak positions are forced out, and only after that purge does the real move begin. What makes the current situation different and more dangerous is scale. Today's silver market is far more financialized. Paper claims dwarf physical supply. Industrial demand is larger. Supply deficits are persistent, and global buyers are far more aggressive than they were decades ago. That means when pressure is applied, the system doesn't bend easily, it snaps. History doesn't repeat perfectly, but it does rhyme. And when silver collapses this violently while fundamentals remain tight, it's rarely a sign of weakness. It's a signal that the reset phase is underway, and now the only question that matters is whether the underlying data supports that conclusion. That's what we're going to look at next. If this sell-off was truly driven by weak demand, we would be seeing it everywhere. Prices would fall, metal would become easier to find, and buyers would step back. That's not what's happening. Even after the sharp drop on paper markets, physical silver has remained stubbornly tight. Dealer premiums have stayed elevated, and in many places, delivery times have stretched out instead of improving. That tells us something important. Real metal isn't being dumped. It's being held. At the same time, something else changed quietly beneath the surface. Futures market participation dropped sharply. Open interest fell to levels not seen in months, meaning a large number of paper positions were forced out of the system. This matters more than most people realize. When prices fall and open interest collapses together, it usually isn't long-term investors leaving. It's leveraged positions being liquidated. Weak hands exit first, strong hands don't need to rush, and the global picture only adds to the tension. Outside Western markets, silver continues to trade at a premium. Buyers in Asia are paying more for immediate delivery, not less. That kind of divergence doesn't appear in healthy bear markets. It appears when paper pricing disconnects from physical reality. Put all of this together. Paper prices fell hard, leverage was flushed, physical demand stayed firm. That combination doesn't signal failure, it signals preparation. Because once forced selling runs its course, markets don't stabilize quietly. They reprice. And the next question isn't whether silver survived this move, it's what happens now that the pressure release is nearly complete. What happens next is where most people get it wrong. After a move like this, the natural assumption is that markets will calm down, drift sideways, and slowly rebuild confidence. But silver has never worked that way. Once leverage is flushed and weak positions are cleared, the market becomes far more sensitive. It takes less buying to move prices, and pressure builds quietly instead of loudly. From here, there are only two realistic paths. In the first, physical supply loosens just enough to relieve stress. Prices stabilize temporarily, volatility cools, and the market catches its breath. This is the outcome many analysts publicly expect. The second path is far more disruptive. If physical demand continues to outpace supply, even modest buying can trigger sharp moves. Inventories don't need to vanish. They only need to tighten slightly for pricing to reassert itself violently. And there are clear triggers to watch. Any further stress in currencies, any new margin changes, any visible drawdown in exchange inventories. These aren't theoretical risks, they're mechanical pressure points. What makes this moment dangerous is timing. Global demand remains strong while paper positioning has been reduced. That imbalance doesn't last forever. Eventually, the market is forced to reconcile it, and when that happens, silver doesn't move gradually. It gaps. So the question now isn't whether volatility returns. It's whether the next move starts quietly or all at once. And that leads directly to what the experts are watching right now. When you step back and listen to what experienced voices are saying, a pattern starts to emerge. Not panic, not euphoria, but agreement. Across analysts, long-term investors, and industry insiders, the message is surprisingly consistent. This move didn't break the silver market, it exposed it. Many point to the same factors: persistent supply deficits, rising industrial demand, and a financial system that has become increasingly fragile under debt and currency pressure. None of those problems were solved by a price drop. If anything, they've become more visible. What's different now is timing. We're entering a phase where small imbalances matter more than ever. Inventories don't need to disappear for stress to appear. They only need to tighten at the wrong moment. And that moment may be closer than most people think. Because regulatory timelines are narrowing, market conditions are more sensitive, and leverage, which once absorbed shocks, has already been reduced. That creates a window where price can move faster than sentiment, where hesitation becomes costly, and where waiting for confirmation often means reacting too late. This is why urgency is starting to replace debate. Not because something dramatic has already happened, but because the margin for error is shrinking. Remember what we saw at the beginning? Violent moves don't announce themselves early. They arrive after preparation is already complete. Which brings us to the only question that really matters now. What do you do before the window closes? That's what we're going to address next. Moments like this don't come often. Most of the time, markets move slowly, quietly, almost unnoticed. But when pressure builds beneath the surface, the people who understand it early gain an advantage that most never see. This isn't about panic, and it's not about chasing every price move. It's about awareness, understanding the difference between paper noise and real-world demand, understanding why violent moves usually happen after forced selling, not before it, and understanding that preparation always matters more than prediction. You don't need perfect timing. You don't need constant action. You need clarity. If this breakdown helped you see what's really happening in the silver market, make sure you like this video. It tells the algorithm this information matters. And if you want to stay ahead of these shifts before they show up in headlines, subscribe to the channel, because what's happening in silver isn't isolated and it's not finished. More moves are coming, more pressure points will appear, and the people who stay informed early are usually the ones who don't get caught reacting late. This cycle is still unfolding. Make sure you're watching when the next move begins.